Hi, this is John Kamarianos. Welcome to a new edition of Capital Considered. Among the big news this week is that gold hit $4,000 per ounce. Greg Ip, senior or chief economics correspondent at the Wall Street Journal, wrote an interesting article saying that results from investors having a lower faith, a lower confidence in fiat currency. Countries around the world, including the United States, have very high debt loads. World leaders, some of them anyway, including Donald Trump, want their central banks to lower interest rates to relieve the country of the debt burden, the interest burden it has to pay. In the long run, many people think that leads to inflation and a debasement of the currency, and so people flock to gold when that happens. Gold is a strange asset. It doesn't deliver cash flow. It doesn't seem to have many uses. And except for thousands of years, it has served as money or a store of value. And that value or that price is going up today. In contrast to Ip, another Wall Street Journal writer, James McIntosh, says, although Ip's argument is plausible, the bond market is not reacting as if the debt load of the United States is too high. If bond investors were worried about the level of U.S. debt, interest rates would be higher. The yield on the 10-year Treasury is still not much above 4%. McIntosh makes a good point. Markets are sort of in conflict with each other in this regard. The gold market is screaming that we're going to get inflation, that a lowering of interest rates in combination with the debt load of the United States will lead to inflation, and so people are avoiding fiat currency. That's what the price of gold is saying, but the bond market is saying something else. So difficult to make sense of it all, but that's what's going on in those two markets. I think those are two good interpretations of what's happening. Third article we want to mention on our list is from our old friend Brett Ahrens. How should investors respond to this spike in the price of gold? Gold is up 50% this year as we speak on October 10th. Can you still own it? Can you still buy it if you haven't purchased it already? Well, you can, but make sure you know that it has run up a lot, and the next move may be down. Nobody knows for sure. It could be up just as easily as it could be down, but it has run up a lot. And so what Ahrens recommends is that if you buy it with the notion of keeping a fixed amount of it, a fixed percentage of it in your portfolio, the way you would any other asset class. So if you're normally a 60-40, 60 stock, 40 bond investor, maybe you go to 60 stocks, 35 bonds, and 5% gold. But keep it there and rebalance into it and out of it as its price move dictates periodically, the way you would with the other asset classes. Ahrens emphasizes that he speaks to a lot of smart fund managers, and none of them really know how to value gold, which makes sense because it has no cash flow, as we mentioned, and not too many obvious uses. So again, it has that history of having served as money or a store of value. So you can still include it in your portfolio. Understand that it's gone up a heck of a lot, not just this year, but last year it was up more than 26% as well. So gold has run up, but the bond market is in conflict with it, and you can own it, but be careful with it and treat it like any other asset class where you would rebalance into and out of it as it moves away from your target allocation. Which could be 5%, could be 10%. Every investor has to decide that. So that's the story with gold. It will be interesting to see what happens for the rest of the year and in coming years, given the debt load that the United States has and other developed countries have. This is John Kamarianos for Capital Considered, signing off. Thanks for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.